You watch the stock you just bought fall another 10%. The news is bad, the headlines are screaming, and that small paper loss is now a significant wound in your account. Every instinct tells you to sell, to cut the pain, to just get out and stop the financial drain. You feel a tightness in your chest. You believe you've made a terrible mistake buying a falling asset. Meanwhile, on the other side of your trade, a completely different mind is at work. A calm, calculating force is absorbing your shares, and the shares of thousands like you, with quiet, methodical patience. They are not panicking. They are executing a plan. This process, hidden in plain sight, is the foundation of every major market uptrend. It is called accumulation. Let's dissect this moment. The emotional state of the average market participant is one of fear. They likely bought the stock much higher up, when the story was positive and the trend was strong. Now the trend has reversed. The company may have reported poor earnings, the economic outlook may be bleak, or a negative story has captured the media's attention. The narrative has completely shifted from optimism to pessimism. This creates an overwhelming urge to sell, to preserve whatever capital is left. This widespread selling, driven by emotion, is not random noise. It is a necessary ingredient. It creates a vast supply of shares, depressing the price to a level that large, informed interests find attractive. The uninformed are selling for emotional reasons to stop the pain. The professional is buying for logical reasons to acquire a valuable asset at a discount. The large operator, the institutional force, cannot simply decide to buy 1 million shares of a company and place a single order. Imagine what would happen. An order of that magnitude would instantly overwhelm the available sellers, causing the price to skyrocket. They would end up chasing the price higher and higher, ruining their average cost and defeating the entire purpose of buying at a low price. Their objective is fundamentally different from that of a small retail trader. They must acquire a massive position without alerting the market to their intentions. Their size is both a great advantage and a great constraint. To solve this problem, they must operate with stealth. They need time, and they need a steady stream of sellers. The panic and despair of the crowd provides exactly that. So they begin the campaign of accumulation. This is not a single event, but a prolonged process that can take weeks, months, or even longer. They absorb shares in stages, buying into the waves of panicked selling. When a wave of selling hits the market, they step in and buy, providing a floor of support. When the price bounces a little, they cease their buying, allowing the price to drift back down. This creates a characteristic sideways price movement, a period of apparent indecision. This is the trading range. It's the battlefield where the ownership of the stock is transferred from weak, fearful hands to strong, patient hands. The public sees a boring, directionless stock and loses interest. The professional sees an opportunity, a quiet absorption of supply that is the prerequisite for any sustainable move higher. They are building a cause for a future effect. The wider the trading range and the longer the accumulation process, the more significant the potential uptrend that follows. It's a direct application of the law of cause and effect. Imagine this trading range as a large, rectangular container. Before this container can be built, the price has to stop falling. This usually happens with a dramatic event known as a selling climax. Picture a waterfall of selling, a day where the price plunges on extreme volume. This is the moment of maximum pessimism. It feels like the world is ending for this stock. Everyone who was on the fence, everyone who was hoping for a rebound, finally gives up and throws in the towel. They sell their shares for any price they can get, just to be free of the position. This massive volume spike is the footprint of the large operator. They are the ones on the other side of that trade, absorbing the flood of supply with enormous buy orders. They are the dam that stops the waterfall. This event is not the absolute bottom. but it's the beginning of the end for the downtrend. Following this climax, the intense selling pressure is exhausted. With the sellers temporarily gone, the price naturally bounces. This is called the automatic rally. It's a purely mechanical reaction. Think of what happens when you push a beach ball underwater and then let it go. It shoots back up to the surface. The automatic rally does the same thing, showing you where the willing sellers are now hiding. The high of this rally and the low of the selling climax often define the upper and lower boundaries of our new trading range, our rectangular container. The price will now likely spend a significant amount of time oscillating between these two levels. Now the testing process begins. The price will drift back down toward the low of the selling climax. This is called a secondary test. But here is the critical clue. This test must occur on much lower volume than the selling climax itself. Visualize this. The first drop was a tsunami of selling. This second drop should be just a ripple. Low volume tells us that the aggressive, panicked sellers are gone. The supply is drying up. The large operator is confirming that their initial massive buying effort was successful in absorbing the majority of the downward pressure. If the price retests the low on high volume, it signals that there are still many sellers left, and the accumulation process is not yet mature. The danger of a further price decline remains high. But if the volume diminishes, it's a powerful sign that the balance of power is shifting from sellers to buyers. Within this range, the large operator will often conduct a more deliberate test. They need to be absolutely certain that the majority of the supply has been absorbed before they commit the capital required to push the price into a new uptrend. To do this, they might orchestrate an event called a spring or a shakeout. Imagine the price suddenly dropping just below the established support level of the trading range, the floor that has held for weeks. For the uninformed, this looks like a resumption of the downtrend. It triggers stop-loss orders from traders who bought inside the range, creating a fresh wave of selling. It also entices short sellers, who bet on the price falling further. It is a masterful maneuver, a head fake designed to mislead both buyers and sellers. The large operator uses this manufactured panic to absorb this last pocket of available shares at the best possible prices. The key characteristic of a genuine spring is the rapid reversal. The price does not stay below support for long. It quickly snaps back up into the trading range, trapping the sellers who were tricked by the move. The volume on the spring might be high or low, but the speed of the recovery is what matters. It is a final, decisive test to ensure the path of least resistance is now to the upside. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding this process is one thing. Acting on it is another. The amateur buys based on hope. The professional acts based on evidence. So what is the practical action plan? How do we align ourselves with this institutional campaign without getting caught in the chop of the trading range? The first and most important tool is patience. You must let the accumulation process play out. Your job is not to guess the exact bottom. Your job is to identify when the process of accumulation is likely complete and the stock is ready to move. Here is the sequence you should wait for, the setup that puts the probabilities in your favor. First, there must be a significant downtrend to halt. Accumulation does not happen at all-time highs. It happens after a period of significant price decline. Second, you must identify the formation of the trading range itself. This is marked by the selling climax and the automatic rally, which establish the initial boundaries of support and resistance. Watch the price action within these boundaries. The character of the market should change from a clear trend to a sideways, often volatile, back-and-forth motion. Third, and most crucially, you must observe the behavior of volume. Look for volume to diminish on declines and expand on rallies within the range. This tells you that sellers are becoming exhausted and buyers are becoming more aggressive. A secondary test of the low on low volume is a very constructive sign. A successful spring is even stronger evidence. These are the elements of the setup. You are a detective, gathering clues. You do not act until the evidence is compelling. Once the setup is in place, you need a trigger, a specific event that tells you it is time to consider entering a trade. There are a few logical points of entry, each with its own risk profile. A more aggressive approach is to enter after a confirmed spring. Once the price breaks below support and then quickly reclaims that level, you can initiate a position. The logic is that the final test has been completed, and the stock is now in the strongest possible hands. This offers an excellent entry price but carries a higher risk because the stock has not yet definitively proven it is ready to leave the range. A more conservative and often more reliable trigger is to wait for what is called a sign of strength. This is a clear, decisive breakout above the resistance of the trading range. Imagine the stock has been bumping its head against a ceiling for months. The sign of strength is when it finally smashes through that ceiling, often on a significant increase in volume. This is the moment the large operator signals their intention to the market. The quiet absorption phase is over, and the public markup phase is beginning. This is the point where the trend officially begins to turn up. Even after a breakout, there is often one last chance to enter at a favorable price. This is called the last point of support. After the initial surge out of the range, the price will often pull back to test the old resistance level, which should now act as a new floor of support. Think of a pole vaulter planting their pole to launch themselves higher. This small consolidation or pullback is the market taking a breath before the next major advance. Buying on this pullback is one of the safest and most effective ways to enter a new uptrend, as it confirms the breakout was genuine. No matter when you enter, your capital protection is paramount. You must define your risk before you ever place a trade. This is done with a stop-loss order. A stop-loss is a preset order that will automatically sell your position if the price drops to a certain level. It is not a sign of failure. It is a tool of professional risk management. It prevents a small, manageable loss from turning into a catastrophic one. If you enter on a spring, your stop-loss should be placed just below the low of that spring. If the price goes back down there, your thesis is invalidated. If you enter on a breakout or a last point of support, your stop-loss should be placed at a logical point below that structure, perhaps back inside the old trading range. If the price falls back into the range with conviction, it indicates the breakout has failed. The specific amount of money you are willing to lose on one trade should be a small, pre-calculated percentage of your total trading capital, typically 1 or 2%. This ensures that a single bad trade can never cause significant damage to your account. It is also crucial to understand that not every sideways range is accumulation. The market is a battlefield of opposing forces. Sometimes a trading range is not a place where strong hands are buying from weak hands, but rather a place where strong hands are selling to weak hands. This is called redistribution. It is a pause in a downtrend before the next major leg down. On the surface, it can look very similar to accumulation. It's a sideways market. But the internal character is different. In a redistribution range, you will see the opposite volume signature. Rallies will be weak, struggling to reach the top of the range and occurring on low volume. This shows a lack of aggressive buying. Conversely, the declines will be sharp and on high volume, showing that the sellers are in control. Instead of a spring below support, you are more likely to see an upthrust above resistance. An upthrust is a move above the ceiling of the range that quickly fails and falls back inside. It's a bull trap, designed to lure in hopeful buyers before the next wave of selling begins. The ultimate confirmation, of course, is the direction of the breakout. If the price breaks down decisively below the support of the range, it confirms that the large operator was distributing shares, not accumulating them. This is why waiting for confirmation, for a clear sign of strength to the upside, is such a critical part of the conservative trader's strategy. It helps you avoid being caught on the wrong side of a major institutional campaign. In conclusion, the process of accumulation is the hidden foundation of all bull markets. It is a testament to the power of patience, logic, and contrarian thinking. While the crowd is selling in a panic, driven by frightening headlines and emotional pain, the informed operator is calmly absorbing their shares, recognizing value where others see only risk. They do not fight the market. They use the emotional energy of the crowd to achieve their own objectives. Your goal as a developing trader is to learn to see the market through their eyes. This means moving beyond emotional reactions and learning to read the story told by price and volume. It means understanding that the market is not a random walk, but a series of logical, orchestrated campaigns. You are not trying to predict, you are learning to interpret the evidence. The clues are always there: the diminishing volume on tests, the dramatic selling climax, the decisive sign of strength. These are not random occurrences. They are the footprints of the smart money. By learning to identify them, you learn to align your actions with the dominant market force. This is not a get-rich-quick scheme. It is the development of a professional skill. It requires study, patience, and discipline. The market speaks a language of supply and demand. If you wish to become fluent, to understand these campaigns of accumulation and distribution before they become obvious to everyone, continue to study its grammar. The lessons are all there on the screen, waiting for the patient observer.